Hello, everyone, and welcome to another episode of the Indy Real Estate Investing Podcast. I'm your host, Jeremy Tallman, and with me today are two guests. First, I have Josh Spiegel. Josh is a loan officer with Integrity Mortgage. And I also have on, he's been on here before, Ted King. Ted's a partner with Goosehead Insurance, both of which are located right here in central Indiana. So welcome to the show, you guys. Good to have you.
Hi, nice to meet you.
Yeah.
Thanks for having me.
Yeah. So Josh, let's start with you. Like you said, nice to meet you. We just met like just 2-3 minutes ago before we started here. So give everyone kind of a quick background on what got you into lending.
Absolutely. So I actually did IT work for Integrity Mortgage Group, and I saw the structure of the company and just the line of work and the atmosphere, and I liked it. I wanted to make the switch over. I'm good at sales. I enjoy numbers. So I made the switch over and I became a loan officer. I've been with them 9 years now. Absolutely love the industry, the company. I'm very happy with where I'm at, and it allows me to help a lot of clients be able to purchase homes for their primary, as well as I've really diversified and got into the investment side. So I do a ton with the investment loan products.
Yeah, I know you work with our group, which is why they gave me your name, and so that's why you're here. So
absolutely.
Ted, you got a long history in the investment world. Just everyone, what's been going on with you the last couple of years since you've been on last?
Yeah, business is still going very well. We've opened a second location in Chicago. So we've got one in Indy, and thank you, one in Chicago. We still write in all of the lower 48 states as far as insurance goes, but we're just building out another team in a market that's been doing very well for us. And so yeah, there's 10 of us on the team now. I think last time I was with you, there was maybe 2 or 3. Mm-hmm. So things have been going really well.
That's great. It's great to hear. My daughter lives in Chicago. Little Italy is where she lives in Chicago. Yeah. It's a great little neighborhood. It reminds me of like Old North Side, Heron Morton feel to it. It's a very cozy little community. So we're up there, more than we used to be because of her. So guys, I mentioned this to you before we hit record here. This is the second installment of a 3-part series that we're doing on converting a personal residence into a rental home. Scott and I had the first installment where we talked about those key decision points that need to be made and really thought through to even decide to convert it to a rental property, because there's a lot to consider there. And I brought you two on to discuss, assuming people do make the decision to say, yeah, I am converting this, the concerns or issues, let's say, around lending and insurance, because things are going to have to change there. And in part 3, Scott and I are going to get back together and discuss if hiring a property manager makes sense or should you self-manage. So we'll get into that in a couple of weeks. So let's get started with this. So guys, when a homeowner decides that, yes, I am going to keep this property as a rental home, what's the first blind spot? What do they miss generally? I'll start with you, Ted. What do you see? Where do you have to advise people to say, oh, remember, you need to do this?
Yeah. So on the insurance side, it's a different type of policy. And so when you live in a home versus you renting out a home, the policies are different. One's a homeowner's policy, one's called a landlord policy. And they act differently and they cover different things. So you definitely want to have a conversation with your insurance provider when that happens, because more than likely they're going to switch you to this other policy. The other part that, unfortunately, I've seen a couple of times here recently with the cold weather is when someone moves out, they don't necessarily have tenants right away. Yeah. And when the insurance world, there's a certain amount of time that if you don't get tenants in place, it's considered vacant. And when a place goes vacant, there's usually 30 to 60 days. After that time period, if you have a traditional policy that's built for tenants, or maybe even your personal homeowner's insurance, a lot of the coverages go away, i.e. a burst pipe. And so with this cold weather, we've seen, investors who have had properties that they just couldn't get tenants in for 3 or 4 months and have a burst pipe that they let the electricity or the heat go off or whatever. And most of the time, insurance is going to cover that if they haven't changed to an appropriate type of policy.
Yeah, it's not a great situation. I can talk maybe a minute on that, because burst pipes were all over the place when we managed 1,300 homes. And so we had a whole lot of burst pipes that were called in, even as we do so much preventative outreach to our residents saying leave your water running, but inevitably some burst pipes happen because the weather we had a couple of weeks ago was significantly extreme, like very extreme. Yeah. And couple that with a very slow leasing season, and there you are, right? It's an empty home for longer than anybody wanted it to be, including the insurance company. And so burst pipes are a reality, and that's not a great thing because we all know burst pipes can do tens of thousands of dollars of damage. And so when that coverage goes away, that's a big problem. So Josh, on your end of things, when you're working with someone that wants to convert their property into a rental home, what's the first thing you go, oh, well, make sure, what kind of blind spots do you see when you do this?
So as far as their current mortgage and where they're at now, when they purchase that home, if you're in a standard conventional FHA, VA, any of those run-of-the-mill products, which most people are, the vast majority, you signed an occupancy statement at the time of closing that you're going to be utilizing that property as your primary residence for 1 year. So make sure you're within a time frame where it's not going to be considered mortgage fraud when you're going to be listing that property for rent. If you're trying to do it immediately after, make sure you're outside the time frame. Standard on all the regular products are going to be 1 year. If you use any of the first-time home buyer programs or unique products that are to your area, I would definitely check with your previous lender or who holds your current note to make sure that you're within right to be able to convert it to an investment property.
Yeah, I've had conversations with people over the years, and I think one guy said the product he used, I believe it was FHA or maybe a variant of FHA, that he had 3 years, right? So he had to stay in that 3 years. But that was his plan. Literally every 3 years, he was going to convert that to a rental property and buy a different one. So it is important, to check with that because you don't want to be down the mortgage fraud road. That's not a great scenario. Josh, let's stick with you. So someone wants to convert it. What are best practices, do you think? Like, in terms of being able to qualify for another house? I've heard a lot of different creative strategies out there. I'm curious your take, what you've seen that, okay, I have this home and I have a certain amount of debt to income ratio because I still have a mortgage, presumably, and I want to move out and make this a rental and buy something different. What are those obstacles that people have to think about to overcome that?
Absolutely. So the nice thing about converting it, first and foremost, from your primary to an investment is the interest rates are a lot better when you purchase on a primary. So having a lower interest rate plus the down payment is less when you buy a primary. So it's a good strategy if you start out with a starter home knowing I'm not going to live here forever. I just have to wait until I can increase my income, get a good enough debt to income, and then save up another 5% for my next home. Now, as far as the debt to income, we do have to calculate that existing mortgage payment into the new purchase, in the total DTI for your new purchase of your next home. There are some loopholes that are within the system that we can do. So, for instance, it's all about timing though. So working with a good team to be able to manage it. But if you set up a separate checking account and an escrow account for that rental property that you're going to be converting, if you get a signed lease agreement and you can have your first month's rent as well as the escrow, which is going to be 2 months, your security deposit in there, we can then order a fair market rent analysis, which is a form of an appraisal on your current home, and we can use 75% of whatever is less between your signed lease agreement and the fair market rent analysis. So you don't have to have experience necessarily, you just have to have that signed lease agreement and those funds put in there. That would allow you to have some extra income to help qualify to purchase and close on your next home. But it's tricky because you're trying to get your house ready to lease, you're getting pre-approved to purchase a home, and you're trying to move out at the exact same time as you're getting a lease agreement and you're going under contract. So it is, if it's your very first one, it's going to be extremely stressful. You have to be good with your numbers, time frame, and have a good support team around you to make that happen.
Yeah, that's a lot. that reminds me, just, I don't know, it wasn't long ago where we had someone approach us and they're like, they'd already bought, under contract to buy another house.
Mm-hmm.
And the message to us was, I need to sign lease by Friday.
Yep.
And it was, that's not going to happen. Like that can't happen. This was like probably, I think it was in December.
Yep.
And it was just not, it's not feasible. They're like, well, I have these time frames. I'm like, you know, the market doesn't really care about your time frames. They're only going to, we're going to rent your home. It's probably going to be at least 30 days, and this, you know, going through holidays and all this stuff. So it was really difficult. Yeah. And you mentioned, Josh, that banks look at 75%. You mentioned a fair market analysis, like an appraisal on the rent. So a bank won't necessarily take a lease then at face value. They're going to do their own analysis on what it should rent for. Is that what I understood?
They will if it's already been in place and you have 1 year history. And it depends on which investor too. So if you don't have any experience, a lot of times the investors will require the both, especially on DSCR loans as well. They're going to look at both, and whatever is less is what they'll utilize. The 75% is just because of the maintenance. They factor that in, being empty a few months out of the year. So that's why they utilize that. But then when you do the fair market rent analysis, they will say it's an actual appraiser that looks at the surrounding community, the different homes, and what has actually went under a lease contract, and they'll say, okay, that's what's going to be what's fair. And so that's the two different methods they utilize to find what your actual revenue is going to be from that rental property.
Okay. So there's a lot to think through there. We'd probably spend a lot more time on that. But the point is, you got to have your ducks in a row, really. You got to think about, what your new property is going to be, get the renting going, all that stuff, because there's a lot of things, unless you're just a high income person. It's like, yeah, you can add a second home, no problem, right? I mean, that could be an issue. It's probably not the case for most people, but so yeah, it's a lot of coordination and a lot of execution that has to happen to pull that off the first time. Ted, you'd mentioned that insurance companies don't like, so at the outset, insurance companies don't like vacant properties, and I understand that vacant properties are at risk. But let's talk about when that resident moves in there. Talk about liability insurance and the product. You kind of briefly mentioned it, but get into the mechanics of how a rental dwelling policy actually works and the liability piece and your thoughts on liability coverage.
One of the most important parts of a policy that's a lot of times missed or just glossed over. I would get as much liability on a policy as the company would offer me. The difference between $100,000 to $300,000 to $500,000 is usually less than $40 a year.
Wow.
So $3 a month. It's so cheap, and I can't tell you the number of policies that someone's rates have gone up and they've asked us to shop against what they have, and we see them with these lower liability limits, and it's just to cut a corner for a few dollars. And so the way it works, I mean, obviously you've got your structural coverage, and there can be loss of rents and your deductibles and things. But when it comes to liability, if something happens at that house and the owner is liable, the electrical's bad and it catches fire, something like that. The handrail on the back porch is not installed properly, so they fall off the porch and break a leg. If you don't have enough liability, they will exhaust the policy, and then in the state of Indiana, we're a wage garnishment state, and they will come up. I think it's 15%, maybe 20% of your check each month, up to 10 years, to pay that other person back. And so, to me, for the extra $3 or $4 a month, like, it's a no-brainer. We put everyone at least at $500,000, and then the companies that'll offer $1 million, we try to get that as well.
So, tell me if I'm wrong here, but a standard, like, if I said, hey, Ted, I want insurance on my personal residence, you'd get me a fire coverage is a big part of a normal homeowner's policy, right? I think that's where the bulk of the money is. The cost is for, well, maybe fire's not the right word, but just damage and all that good stuff. But I think, is it standard to put on a $300,000 liability on a standard homeowners coverage? Is that pretty normal? 300,000?
Not in my office. Maybe in
Oh,
other
really?
offices, but no, we have half a million. Yes.
Half a million
Again,
for personal residences.
oh yeah. And the
Okay.
reason is for $2 more a month, why not go to half a million?
Yeah.
To get, I mean, medical costs are at an all-time high. And then if they, want to be a bad friend or whatever that was at your house that wants to try to sue you afterwards, and it can go quickly. And so
Yeah.
to spend an extra 25 bucks a year for an extra 200,000 in coverage is, to me, is a no-brainer.
So just so I can speak intelligently, I think I already kind of know what your answer is going to be, but a lot of our clients come to us and they say, well, I've got a $300,000 liability coverage and our contract requires 500,000. Okay. What, again, cost difference, $2 a month? Is that what it's going to come up
It's
to be?
super cheap. I mean, it varies from company to company, but $2, $3, $4 at most more, maybe.
Yeah. And if you're advising landlords out there, I think you said it, you advise as much as the company will allow you in liability. So 1 million is probably a very good option if the company will, which
If
I
they
think
offer.
most companies will go to 1 million, won't they?
It's about 50-50 these days, honestly. Half will cap it off at half a million, and then the other half will get you up to a million. So it just depends.
Okay. So talk about, you'd mentioned handrails, and that is a huge pain point for our clients. It seems like when we take on management, we do what we call like an onboarding walk through the property. Inevitably, I don't know what the hit rate is. It feels like it's a pretty high hit rate where we come back and say, you're out of code, you're out of compliance with the current handrail laws. How often do you have handrail claims? Do you have any sense of that? Because we have, over doing this, we've had people slip and fall. And so handrails are really important to us. And I think it should be really important to our clients because we don't want our clients getting sued. Do you see that a lot, or like liability claims? What do you see hit liability claims?
Yeah, I think you're onto something there. And I think it is, especially it stems from the part where we're talking about maybe homeowners converting their home to a rental. And they don't have the eyes probably because they lived in it for so long
That's right.
see it in a new way, and to see the risk of someone that's not your friends or family, that doesn't have a personal tie to you, that might, even if they did slip and fall, just sort of work it out between the two of you. Where if it's a tenant and they slip and fall, their thought might be, I'm going to get as much as I can.
Mm-hmm.
So it's really important that you guys do that, which is great. A lot of insurance companies post COVID, I used to see about 1 out of every 4 new policies have an inspection. I would tell you now I'm seeing 8 out of 10 get inspected.
Wow.
So the insurance companies have really stepped up their attention to detail with these homes. And we're also seeing it renewal. So you may have already had a policy with the carrier for 2 years and then they didn't inspect it at the beginning.
Yeah.
And now 3 years in, they want to come by and check out your handrail. So they show up and are looking at your roof and sometimes non-renewing you because they don't like some of the things that they see. So from a liability standpoint, I mean, yes, we definitely see claims when it comes to handrails or porches in particular, or anything that's off the ground where someone could fall. Pools are a big one. I mean, not that a ton of rentals have pools, but that's also a big one. And then probably the biggest one is dog bites, believe it or not.
Yeah,
We see
I've
a
heard
lot
that.
of liability claims with dog bites. And so landlords having conversations with their tenants about dogs and what the plans are. And one, they should always have their tenant get renter's insurance with a company that, if they're going to have, especially a vicious dog breed, not that the dog itself is vicious, they just have a list that they call it that way, but it's your Doberman Pinschers and Pit Bulls and of the world.
Yeah.
But if they're going to have one of those, have them have renter's insurance that will cover a dog bite so it doesn't hit their landlord policy. And one of the things that I do is, I'm not allowed to pay for someone else's renter's insurance, but I can give them a discount off my rent of $12 a month to cover the renter's insurance. So instead of paying $900 a month, they're paying $880 or whatever, to make sure that I'm even better protected. And so I usually do that for my, couple of rentals that I have.
Yeah, I could probably, again, spend a whole podcast on talking about, we require renter's insurance too.
Yeah.
And so we have a lot of renter's insurance policies, and it's every month that we're filing a claim on the renter's insurance. kitchen fires, you name it. Just so many different when tenants cause damage, then that renter's insurance kicks in. We had a check come in here this week for over $50,000 for a kitchen fire that renter's insurance paid. So the homeowner's insurance probably would have paid it, but it's a claim, right? It's hassle. It's all this. So I assume the owner was very made aware of what was going on, but they rest assured knowing, well, I don't have to deal with that. That's a huge relief. So renter's insurance is one of those things that's like, well, that's whatever, Yeah, you need to do it because if you do it long enough, you're going to have a circumstance where renter's insurance kicks in and saves you. So, Josh, we talked a lot about preparing, and you kind of got my mind thinking back to that, some of the points you made through. But if someone is going to do this in the next 6 to 12 months, like what's a really practical way to, and maybe even sooner, it's like, hey, I want to move this summer, right? What should they be doing now to kind of get ready to avoid that chaos you talked about that can sometimes happen toward the finish line?
Yeah, I think making sure the basics of if you're going to be purchasing another home, working on the debt to income, figuring out what your strategy is on where you're going. I think we talked about someone that's got a lot of cash flow and good income. This is an easy process for them. But also I see a lot of people that when you're planning your future with your significant other, you're getting married, and you have one person has a house, the other person has a apartment. Well, does it make sense to sell the house and buy a bigger one that's yours together? Maybe it'd be, hey, let's move into the apartment and I'll rent this out, and then we can save up and be able to. So working with your life plan, with your relationships and that, I think that's a great opportunity for these people to go ahead and keep that. And instead of selling both houses and buying us a house, utilizing that, but work with your time frame of your life and what your plans are there. I think can make it a lot easier through that process because you can utilize living with a significant other or a method that way.
Yeah, I think it is a true pro. I don't know, pro hack's the right term, but to say again, like you mentioned, to avoid. So if I just stay in my house, let's say I'm going to keep this interest rate because I really want it. I don't want to move, but I want to buy a rental property. The difference between, you could probably tell me like today what you're quoting for a primary residence versus a rental property. I'm sure there's a fairly big difference. What is it today?
It's going to be somewhere between 0.5% and 1% down, difference on the rate. But you're also looking at the fact of, are you putting 5% down versus you have to put 25% down to get in that range, not 20 and 25. There's a big difference between 20 and 25 on the investment properties right now. So that's where it makes a big difference, not only on your cash reserves, but also the monthly payments considerably less too. Another thing I think, when you're planning it, a lot of people don't realize that when you're in your primary, you have that homestead exemption. So once you move out and you're purchasing another one, you're going to want to make that your monthly payment lower, especially because you're buying a more expensive house for yourself. So you get more of a savings applying that homestead. So make sure you look at what is my property taxes going to be once I move out? How's that going to affect my cash flow on the property? Because it is going to go up.
Yeah, that's something that Scott and I brushed across. I'm glad you brought it back up because that is something that if you're doing this, you really need to think about. And something we tell our clients is that when you buy a home, expect the property taxes to double. Now that's assuming that there's a homestead exemption sitting on it. So if you're sitting in a primary residence right now and you pay $2,500 a year in taxes, let's say, just an even number, you need to budget for $5,000 a year in the next tax year, right? Because you're going to go from that. We're in a 1%, 2%, 3% tax system here. And that is something really important to mention. But you're right. You'd rather have the exemption on the more expensive home. And so presumably you're going to go up. Generally, you're going to probably go up in value in the home that you decide to buy. So it does make sense if you have to choose the homestead on the higher assessed value home. So yeah, that's good stuff. Ted, anything you're thinking about in terms of if someone's thinking about doing this in the next 6 to 12 months, like from an insurance standpoint, kind of what what they need to think through?
Yeah. So I think something we mentioned earlier, which I think is so important, I think Josh touched on it, but it's basically building your team. You know,
Hmm.
one of the most important things, whether you're local or you're out of state, is to find people that are like-minded, that understand you and your goals and what you want to accomplish. And when you use a team that works together, I think that's easier to do, to understand. One of the things that's really big in my office is we're not just trying to insure the one property. We want to talk about the investment strategy, because the way I might insure one or two is going to be different than I would insure 10 or if you had 50. So working with a team that understands your goals, I think, is super important. I think the other thing, if you're coming into the Indy market and maybe you don't live here and it's not a conversion of a home, one of the things I see missed by investors a lot is they don't pay that extra $200 or $300 and have their sewer scope.
Mm.
There are so many times that an investor will buy a property, we do the insurance, and 2 months later they come back and go, oh no, toilets aren't flushing right, water's not going out. We had someone come out and they said there's tree roots growing all through the sewer. I want to file a claim. And unfortunately, those tree roots didn't grow into that sewer in the last 2 months. It's been growing for a few years. And so
Yeah.
it's prior to the start of their policy, and a lot of times the insurance company won't cover it. And
Mm.
so paying that extra just $200 or $300 to have that scope to save you an $8,000 to $10,000 claim, or $8,000 to $10,000 out of pocket,
At
I think
least.
I think is well worth the money to have that done. So I do see people skipping that step, cutting that corner, and paying dearly later for it.
Yeah, I think there's some wisdom there, and I think if you think about like the mindset of an investor that works a W two, or maybe a want to be investor, someone that's thinking about doing this, they're working a 9 to 5 job probably. So this is kind of, they're doing this stuff at nights, weekends, and they're jumping on to, I don't know, doesn't exist, but mortgage.com, whatever online company, and getting pre-approved. And they're going out to different insurance companies, and yeah, that's fine. You can do it that way, but I do think there's a lot of value, like you just mentioned, Ted, in having a conversation with Josh or Ted about, this is my strategy and this is what I want to do, because you may have a totally different product in mind for them then. And as an investor, you don't know what you don't know. And if you're doing this, you're converting a personal, you've probably never done this before, and you need to talk to a couple, at least a couple, and probably in some cases a lot more pros out there to really advise you. This is not, I want to caution you, don't make this like a commodity. Don't treat mortgages and insurance like a commodity, because they're not. They're all different. The coverages can vary widely or wildly. So I really like what you said there, Ted. So I'll throw it back to Josh. Josh, anything else you have in closing that we didn't talk about that you think is important to kind of go over with in people in this
I
situation?
think Ted hit a really good ending point there with the team. So
Mm-hmm.
having the right people to structure and look at your investment portfolio and your plans moving forward is the key to being able to have success in this, and making it happen and making it profitable for you. So looking at every angle, I had one not too long ago that reached out just a couple weeks ago, and I was thinking about the same thing. And because it's his primary, we just did a cash out refinance and got his rate down from sevens, mid sevens to the low sixes. And that way he can have a lower payment when he turns it into a rental here next year. So the little
Yeah.
things like that, when we're looking at it from a bigger view, having the right insurance company, having the right realtors. You guys at TNH have an outstanding team there to help look at different properties, see if they're a good fit for the client, all the ins and outs that they see on a day-to-day basis. This is going to be a new process. They don't know what they're looking for half the time, because they don't have the experience and haven't had the hassles of frozen pipes and messed up sewer
Yeah.
lines, handrails. So having someone that has the experience be like, hey, I see this. This might be an issue. It will help you avoid costly mistakes and make the process a whole lot easier for yourself.
Yeah. Ted, anything you want to go over in closing that I missed?
I think that's just, especially whether you're new or old to the investment game, having the right team, having the right people, having the right strategy, and reevaluating.
Yeah.
Strategies change,
Yeah.
and as some of these products change, some of the things that insurance used to cover, because of cost, they've stopped covering. And unless
Yeah.
you sit down with your team, your insurance guy, and have that conversation, you may not even know that they're not doing X, Y, or Z anymore, or at the renewal they jumped up your deductibles or whatever. So having continual conversations with your team, your property management, talking to your lender, like what's going on with the rates these days, what do we see coming in the next quarter, your insurance guy, it's just so important. And you just got to find people that are like-minded, that want to help you accomplish your goals, because if they keep winning, then your business naturally will grow with them. And just find those like-minded people to continue to partner with is super important.
Yeah. Well, guys, I appreciate you being on here. Josh, if people want to reach out to you, how do they do that?
They can reach out to me at my website, imgindiana.com, and I'm sure I have my phone number. Google me, Josh Spiegel.
Yeah.
I'm out of Zionsville. My office is in Zionsville, so I'm local and been here and love to work with anyone or consult with anyone to be interested in getting their first rental property. Love to work with you.
Yeah. Ted, how about you?
Yeah, website is tedkinginsurance.com. And
It's a good domain.
Right. My entire team's there. There's 9 folks on there. You can reach out to any of them or myself is fine, but all the phone numbers and emails and things like that.
All right. Well, guys, appreciate you being here.
Thank you very much for having me.
Thank you.
Have a great day. Thank you.
Yeah, we hope everyone has picked up some information that will help them in their investing. We'll be back in 2 weeks with another podcast. Until next time, thank you so much for listening, and please stay invested in your investment.